Dude, if you keep doing these stories, we're not going to start. Josh has to go.
Let's just do stories. Just forget about podcasts.
Teacher conference.
Yeah.
First one is the 50-year mortgage, right?
Okay.
The standard 30-year or the standard mortgage was the 30-year, which only became, the standard mortgage about 30 years ago. Before that, it was 15-year mortgages and 20-year mortgages.
Okay. 30 years ago.
Yeah.
Okay.
So it's been and so the 30-year mortgage now is the most common mortgage. Moving to a 50-year, I get the thought process behind it, right? Like if I can get my payment down another couple $100 for every $250,000, that could increase my purchasing power X amount of dollars,
right?
Or it makes it more affordable. Where it gets a little wonky is when you're kind of looking at the amount of interest you're going to pay over those next 20 years.
What do you think, Frank, about this 50-year mortgage?
I mean,
Are you against it? What's your as a real estate professional?
As a real estate professional, I'm more conservative guy.
Professional, long-time homeowner. I mean, you're kind of you're like one of the most savvy owners. Let's tell the public.
To Josh's point about someone bridging the loan and refining, like there's some people that make like they do tips, they don't report it.
Okay.
So some people are like, oh man, like an FHA. What's the DTI on FHA? That's income.
Technically, you can go to 57%.
So 57%.
Okay.
So it's like if like the only reason I recommend that is like, okay, the guy's making tips. Maybe he's not on paper. He's making that money.
Yeah.
Then it's like, okay.
So that's the only reason.
Makes it.
I still think it's good because inflation's not stopping, and prices keep going up, and the real estate
versus a 30.
Yeah, real estate right now is a hedge against inflation. But real estate is an asset that keeps up with inflation.
Yeah, but you have the real estate, whether you have a 30 or a 50.
Yeah, but the 50 you're going to get in with $300-400 less in the 50-year mortgage. And maybe some people like they're really tight with the numbers. Maybe they couldn't even buy a house with that.
Oh yeah.
Now they could buy and not rent for
I
French
think it's
and pay $2,500 and have their own house. So anybody that purchased a house is smart. Anybody that did not buy was stupid. So if anybody did not buy 10 years ago, if he rented for the past 10 years, he's worth 5
years.
Even 5 years. He's worth 100 to 200 grand.
Oh, easy.
And the guy that rented is worth zero, and the guy who just bought a house doesn't even know what he did.
Yeah.
He's worth 100 grand more without doing zero.
Well, you asked me a question. I'm just answering.
I'm just saying they want that. You're
just answering.
You're trying to be Dave Ramsey here and trying to fix the problem. People are like, oh, how are you gonna like save money, dude? They want that. It's like the credit card. They exist.
I agree.
They want to really people like well-being and make them save and not rip them off with interest. They will eliminate the credit cards or make sure they cap them off at 10%.
Hello, everybody. XR Podcast number 63. I'm here. Obviously, Greg's here. We got the lovely Melissa Mason with us, XR Realty, and we got the best lender in town, Josh Jones with Loan Depot. So, welcome, guys. Hi. So, Melissa, why don't you tell us? You kind of one of the new, the new to the crew.
The newbie of the office.
And just tell us a little bit. You were a realtor admin.
Yeah.
Which must have been like a realtor.
I know
punch.
everything.
You know everything. Where you like,
For
you got to deal with the lovely realtors' personalities.
I know. I had
about
to
that?
clean up a lot of messes.
Yeah. And then you get your
so
license.
I was there for 15 years, and then 9 years in, that's when I got my license. After I see everybody making money, I'm like, hey, I could do this too. I'm nosy. I like to look at houses. I like to meet new people. So now I'm full time for the first time. So I'm still getting used to it. Still getting the hang.
I mean,
of
besides
it.
that, meet people and nosy. You're pretty knowledgeable.
Yeah, no,
you have experience.
sure,
You know all ins and outs. Today you created a whole market. Market update and stats about areas that you're going to talk about in a little bit. So we're excited to have you.
Yeah.
We're excited.
And she knows all the right paperwork to
Yes.
get. I don't have to worry about
This
Melissa.
is true.
She's like, boom, boom. She's teaching me stuff.
Yes.
So it's awesome.
But I'm super excited about this podcast. We're going to go right into it because we're going to talk a lot about it. And then, and then it's Josh and Jones. Joshua here. I know forever.
Yeah. I am Josh Jones. I'm with Loan Depot. I've been a lender now. I'm getting ready to start my 20th year or 21st year.
We got to get this man a cake.
Old man.
I feel like it's been a lifetime. We all look a little older. We used to lie about our age. We would tell people when we were like 23 that we were.
Please don't say you know me for 20 years.
Yeah. Yeah. We would say, oh yeah, we're 30 and now we're finally old.
We got our age.
On the 4th floor.
But anyway.
Yes.
Okay, welcome.
Josh Jones. We're gonna do market update today, so I'm excited. We're gonna talk. We're gonna go back to real estate. Last podcast was wine. It was a lot of fun, but this one will.
Where's the wine?
No wine today. We
No
got
wine today. No wine today. You missed it.
We got a little tipsy that day.
No, we didn't.
Yeah, not gonna lie. But today we're gonna talk about market. We're gonna talk about real facts about real estate, right, Frank?
Yeah, that's right. I mean,
And,
what are you seeing out there? You know, how are your listings moving?
They're a little slow.
Yeah, mine too.
Yeah, I'm not gonna lie. They're a little slow. It slowed down right in August. You know,
Which is typical.
yeah, right in August. That's why I go on vacation in August usually. My big vacation in Italy because I know it slows down. The typical, right, Melissa?
Definitely.
It's kind of, we were talking off cameras. It's the weird time, you know, around Chicago. It slows down a little bit, and but now, thank God, you know, of course, need money to survive. Right after the holidays, like before Christmas, there's a little rush,
Little
right?
push.
A little push, and so some of my listings are now,
Yeah.
you know, got contracts, and we got them under contract. But besides that, I feel like a fourth quarter in the normal market, because around COVID market, I think it was completely different.
Yeah.
It was a weird, you know, rates were down, COVID, people were itching to get out of their apartments and upgrade. All the quarters looked the same.
Yeah.
The COVID market, in my opinion. But now we're going back to like pre-COVID, where it's normal to slow down. Right, Josh?
So is it that people don't want to move like when the kids go back to school, or what are you guys thinking? Or the holidays?
I think okay, if we're comparing COVID, I think with COVID, people were home and they were bored. Now I got a holiday party, I got this. They're distracted more. Now, if you're in the city, it's not. I mean, it's affected, but not as much. But I think if you're like Naperville or a school district driven market. And depends on the price point. If you're 350, 400, you're gonna have better luck than if you're a 6, 7, 800,000. Because those guys, they're a second time buyer most likely, so they got to sell something. They already have a house. They're not renters. So if you're around a market like where our office is, there's more renters. I mean, there's more apartments. So those people, they don't own anything. They could have that flexibility, but if someone's got to sell something, it's just a little bit tougher. I find because they're not gonna make the move now. They're gonna be like, we'll do it after the new year.
Yeah, I think the buy and sell, it's different right now in this time, right?
Yeah.
And then the schools are going to affect a lot. You know, in the burbs, big time. You know, who wants to move? You have kids. Who wants to just move in the middle of the school year, right?
Well, you got to worry about,
You know what I
you
mean?
got to put your kids in a different school then.
Yeah.
Out there. It's a lot of work.
But yeah,
Yeah,
or trying to stay in the same one, and then it's like, okay, so
Yeah.
there's still people that have to do it. Life change, something happens, and they got to sell.
But I still think if you're a buyer out there, I think you should look.
100%.
I advise it, even if maybe you could be able to wrap it up, get it done, extend, like push like the closing date, right? And then maybe hold off a little bit until whatever your school year of your child is over. But then you get a great deal now.
Yeah.
And I feel like these are the time when you can negotiate, you can get better deals, you can work stuff out, right? But Josh, okay, so you're here. You obviously see the applications more than anybody, right?
Yep.
So is this a time for you to slow down too right now a little bit?
I think what the mortgage industry is seeing right now is purchases have fallen off, but refinances have picked up because if you go back a year and a half, the average mortgage rate was probably above 7. And so you have all these people who are like 7.25, 7.5. They're refinancing now. They can get somewhere in the mid to low 6s. The purchase market, though, you're finding that, one, the sellers are willing to negotiate. 2, the sellers seem to be willing to accept a sales contingency in the summer. Forget about it.
Yes, no chance.
But in the colder months, they're like, I don't want to move around Christmas. Let's do a January 31st close, and I'll accept your sales contingency. So it's been nice for the people who have to have a sales contingency. And
Correct.
So but I mean, it's been steady, but refinances have picked up for sure. Purchases, they're kind of tailing off.
Yeah.
Do you see like pre-approvals are kicking up? I should get a contract. So like, when does that usually?
So I would say you have a lot of people who make their New Year's resolutions, right?
Yeah.
Like January 1st, looking at all the fireworks going on. This is the year I'm going to buy my first house. And so you will get a lot of people wanting to get pre-approved in the beginning of the year to get ready for the spring market.
Yeah. The 2026, I think, I mean, we'll touch base with 2026 in a little bit after in this podcast, because we're going to talk about like big stuff, what we predict and what's happening with the economy in general. But right now, I want to go back to this fourth quarter because obviously we're XR Realty. We're here right on Harlem and Dunning, and we like to know our market, right? But we do work a lot within an hour from the office around, north, south, west, even east. So today we want to talk about 3 particular areas and give you some stats. So I have lovely Melissa here, one of our newest agent at XR. Welcome, by the way.
Thank you.
And she'll give us some stats about fourth quarter in Dunning compared to 2024 and 2025. And then Schaumburg, where she actually even lives there, and Mount Prospect. And those are big areas where a lot of people from the city are actually relocating there for the schools or for burbs living. And I have actually live listings. I'm doing an open house this weekend in Mount Prospect. So go ahead.
Yeah. So it looks like in the fourth quarter of 2024, there was 97 closings around here.
That's for Dunning?
Yes.
Okay.
And right now we're like at 40.
Wow.
So,
Wow.
Okay.
So
that's
they could be inventory or it could
Oh,
be.
absolutely. It's definitely inventory. based.
Okay.
Well, what's the prices?
Okay.
So
That's
the
it.
average last year was 385, and now it's
Okay.
at like 415.
Okay. So we do see an increase for
The
Dunning.
increase went up.
Okay. But less inventory, less sales, especially in the fourth quarter.
So when the news says, sales are down, it's because the inventory, the prices are still up. So people that think like, I hear real estate, it's going down now. It's a price. It's like it's going down. They're just saying, the transaction went down because there's nothing to sell.
Exactly.
The prices are still up. So that's
Okay.
just don't get misled with the
Yeah.
news sometimes. Well, we go Mount Prospect.
Yeah, that's another like really popular area. People are moving there for the schools. They had like 97 closing last year at this time, and now they're at like 66.
66.
So
Okay.
it's-
And days on the market? Do you have that?
Days on the market was 37 was
Okay.
last year, and then 35. So.
Okay. So still
Yeah,
Pretty
nothing.
steady.
But less closing. Let's remember that. This is the second area. Less closing, fourth quarter. There's not as many closing of 24. And 24, I feel like was still kind of not, it was a busy year, but not as busy as like 22, 21, and 23. And now we even have less than that. But go ahead to the next area.
All right, Schaumburg, my home. So they had a lot of closings in the fourth quarter.
Okay.
158 for last year. And
For 2024?
Yes.
Okay.
And now they're at 113.
Okay.
That's like a
Sure.
29%.
Okay.
Drop.
Pretty much.
But there's
30%.
still time left.
Yeah.
So they could.
Till the end of the
It's-
end of
Yeah, it
December.
could.
Yeah.
A little bit. It could. But I mean, time like we have a month. I guess
30 days.
40 days or something. I mean, it could catch up, but I feel like they're going to be lower all 3 areas.
What's the prices? What was the Mount Prospect price again in the Schaumburg one?
Mount
From last year to this year?
Mount Prospect was 468 last year, and this year it's 465. So that one didn't change.
Pretty steady.
Okay.
Pretty flat.
Schaumburg was 400 last year, and then like 370 this
Okay.
year.
And this is the average price.
Yeah,
For
and
the
then
average
it
price.
doesn't look like they had that many like, big home sales. This
Yeah.
year, so that's.
I mean, it's
like,
just a
why
big
that-
town, so it's kind of tough to.
Okay. What I see, based on 24 and 25, I think this year is where things are kind of like, rates were up, there was inflation. Now the rates are going down again a little bit. I feel like it's slowed down a little bit, It's getting back to normal, and the economy is kind of like, we're not bad, but it's kind of like, it's kind of like
Everyone's staying
a lot
put.
nervous, right? I think Josh probably could talk more about this, like jobs. For me, real estate runs a lot about jobs. Are the jobs, what's going on with the jobs? Yeah.
Well, today,
Talk about it.
finally, after the government was shut down for 42 days or
Okay.
whatever it was, they started releasing the economic data that
Okay.
never came out. And so we got the September jobs number in late November, which is
Yeah.
first time
Yeah.
that it was weird, but it showed that the job market is strong.
Okay.
The unemployment rate ticked up a little bit,
Okay.
but people's wages are still good.
They're good.
And so until the wages start to come down and the job situation gets worse, we're not going to see interest rates coming down. And so
Okay.
if if the interest rates come down, hopefully the housing inventory comes back, and then we can get these people.
So you don't see the rates going down. So I feel like I'm analyzing the administration because I feel like they wanted the rates to go down, right?
Yeah.
To boom more the market, but they're seeing a little slowdown, and they want the real estate it's big around the economy.
Yeah.
And so now they're proposing some creative stuff, right? 50-year mortgage, portable mortgage. Tell us more a little bit about that.
Okay, so the first one is the 50-year mortgage, right?
Okay.
The standard 30-year or the standard mortgage was the 30-year, which only became, the standard mortgage about 30 years ago. Before that, it was 15-year mortgages and 20-year mortgages.
Okay, 30 years ago.
Yeah.
Okay.
So it's been and so the 30-year mortgage now is the most common mortgage. Moving to a 50-year, I get the thought process behind it, right? Like if I can get my payment down another couple $100 for every $250,000, that could increase my purchasing power X amount of dollars,
right?
Or it makes it more affordable. Where it gets a little wonky is when you're kind of looking at the amount of interest you're going to pay over those next 20 years, which is, it's kind of like a generational mortgage, right? Like in 50 years, if you're not going to pay this thing off.
But that's if somebody doesn't do nothing, right? Let's say they just leave it like that. They don't think, and there is a good percentage of the population does
never
that.
touches it.
And you're going to pay a lot of interest, right?
Yeah.
But what about your little savvy, or you keep up, the time? Now these days it's a little bit different. You send them the mailer that the rates got lower. They got a lot of information on their phone, and they refinance throughout the process. I mean, what do you think?
The only way that the mortgage world is seeing the 50-year is going to make sense is if you use it as a bridge to your next loan.
Okay.
So if you're like, I wanted my payment to be 5 or 8% lower. Great. And then once I figure this house out, once I get more comfortable or get a couple raises under my belt.
You almost leverage.
Yeah.
And then I'm
going to refinance it into a 30-year then at that time. Okay. But in theory, paying much more interest over that extra 20 years, it doesn't make sense. But then you also have a much larger tax write-off, which no one is talking about or factoring of the mortgage interest.
Okay.
So you're paying a lot more interest, which means you think it could be real? It could this 40. I mean, I don't know about 50 is gonna be real, but I feel like 40 is gonna be real. I think they're gonna the industry tried the 40.
I think it's gonna come.
Yeah.
But then this year when they tried 40, it was a different market. Like prices like when the industry was trying 40, the prices were 100,000 less.
Easily.
They're 100,000 more now.
Yeah.
And the problem is that they're not going down unless there's a crash.
Yeah.
So if they're not going to crash the economy.
No.
In my opinion, not going to crash the economy. So what's the other option? Like back in the day, 30 years ago, why did we do the 30-year? You know why?
Yeah.
Because inflation was going crazy.
Yeah.
And prices went up, and people were making more money, but prices were not going down anymore. So they had to do a 30-year to make people more.
People do it anyway. I mean, the odds of someone not refining ever is very slim.
It could be.
The average lifespan of a mortgage just here in the Midwest is between 5 and 8.5 years.
Yeah.
So every 5.
So 8 years, now you got 38 years.
Yeah.
And then another 8 years, you got another.
Yeah. Correct.
What do you think, Frank, about this 50-year mortgage?
I mean,
are you against it? What's your as a real estate professional?
As a real estate professional, I'm always. I mean, I'm more conservative.
Real estate professional. Long-time homeowner. I mean, you're kind of. You're like one of the most savvy owners. Let's tell the public.
To Josh's point about someone bridging the loan and refining, I think just human tendencies, it won't turn into that. I think they'll just pay the minimum and keep it, or they'll use it to. And I think people that have a 30-year will just be like, just give me the lowest payment.
So what about that? Let's talk.
But, so I mean, that's what I think will be used. I think.
Let's say somebody just pays the minimum and just keeps it, right? And does a 50-year mortgage, doesn't think about it. Doesn't do nothing. I still think it's good because inflation is not stopping and prices keep going up, and the real estate
versus a 30.
Yeah, real estate right now is a hedge against inflation. So real estate is an asset that keeps up with inflation.
Yeah, but you have the real estate whether you have a 30 or a 50.
Yeah, but the 50 you're going to get in with $300-400 less in the 50-year mortgage. Then maybe some people they're really tight with the numbers. Maybe they couldn't even buy a house with that.
Oh, yeah.
You know?
Oh, yeah.
Now they could buy and not rent from Frank Scaletta
I think it's.
and pay $2,500 and have their own house.
I think if you could.
Wait, well, what's wrong with that? And they get, if you rent from you, they're gonna get. I mean, 20 years are gonna pass by, and they're gonna own.
I'm always
shit.
pro buying. I think if that's what puts you over the edge to buy versus rent, then yeah. But I think the best thing, which with the rates not coming down for people, is they don't refi. And they don't use their house as a bank. Okay, so when rates keep coming down, people bought a house for $200 back in the house for $350. Bought pull $100,000 down.
Yeah, but that's an issue that they know there's a think about right
Why
now.
do people don't buy? How come people don't buy? You think, Josh? What do you think? How do people like just don't? They like
they don't
they're
buy.
like 40 years old. They talk about buying. They're like they go through the late 20s, 30s.
Different reasons.
I have some, pre-approvals from 15 years ago that every few years they come back. But, I think it's either
Some of
one.
my clients.
Yeah, right. It's the idea, number one, right? Like, it could be more expensive. And in some cases, it might be more expensive to own based on certain areas. But in general, you can find something to probably own what you pay rent for.
Well, they
Loan shark.
They people
they're legit loan
right now. They got like $40,000 credit cards. Let's just take the $40,000 out of we refi, take the $40,000 and we'll put our loan in this, and then they pay it off. Again. So
But I'm circling back to the 50-year mortgage. The refinance thing, I'm not even concerned.
it's not my choice. But I think most people will buy something they probably can't afford if you do 50 years.
But you think it's good or bad? I think it's a
private.
percentage of people. Like, I think that's part of it. Some of them are those people, like, the new hip guy that knows everything, that watches YouTube, watches every pro show, and then never pulls the trigger, right? And he's waiting, and then never buys. Then you got the one that is uneducated. Parents never bought a house. They just don't know better.
Yeah, there's
and they
rental
just think like all they could do is rent. That's all they think. They think like, I think that. Then there's ones that are afraid of doing maintenance.
Yeah.
Of working on the house. They feel, you know what I mean? So I think it's a mix, but the thing is that I feel like, what we have right now, what's the stat? We have 60% or 40% are renters in the United States.
It's like 68 or something, or 65 are homeowners.
Okay, but the homeowner increase, let's go back to 30-year mortgage, talking about the 50-year mortgage, the homeowner increase once they actually established a 30-year mortgage. Is that correct?
Correct. And they reduced the down payment from 20% to.
Then you had more homeowners.
You had Fannie Mae and Freddie Mac created.
If they have a 50-year mortgage and they stay in, let's say something happens, or let's say, God bless, right, knocking wood, they pass away. If they had the house, if they rent for 5 years, they're going to leave their kids zero. If they have that, 50-year mortgage and they stayed there 5 years, all of a sudden they have not much equity principal, right? Because they're not paying off their principal that much. But maybe they have some equity just because they bought the house 5 years ago and prices went up.
I'm gonna.
I mean, listen. I'm sorry to interrupt you again. Right now, the problem is that I'm all against a 50 years. You're gonna pay a lot of money, but right now, what I've been seeing the past 20 years, houses keep going up. So anybody that purchased a house is smart. Anybody that did not buy were stupid. So if anybody did not buy 10 years ago, he rented for the past 10 years, he's worth 5
years. I wouldn't even go 5 years.
Even 5 years. He's worth $100,000 to $200,000.
Oh,
less.
easy.
And the guy that rented is worth zero, and the guy who just bought a house doesn't even know what he did.
Yeah.
He's worth $100,000 more without doing zero.
I'm gonna change it to. I would do a 50-year.
That's it.
No, that's fair.
I would do a 50-year if I'm above 60 years old. 65.
And if you want a fixed income, then at that point, right?
I would just.
Lowest payment.
Yeah, because I'll just get lowest payment. I'm not gonna the 30-year. I'm not gonna outlive. Probably not.
Yeah.
50-year.
For me, it's
the
about
middle road. Then I would be reluctant to do it because you're already paying. Like if you owe like $200,000-300,000 and you're 65, you might as well just
you're not
drop the payment.
See,
you're trying to get to 90 and be your house paid.
See, I think, Frank, for you, it's hard for you to answer because you're more like really, really like old school, and maybe a little bit Dave Ramsey style. And no, he is. And he's Sicilian, and they do 10-year mortgage there, and they pay off their house, and then that's it, right? That's you. But the majority of people out there want nice stuff and want a nice home And real estate is almost
Not me.
like
I don't want
It's
nice
almost
stuff,
like
nice home.
a lot of people don't invest. Wait. You're that. A lot of people don't know to invest in the stock market. A lot of people don't do flips. A lot of people don't do second jobs. So even if they buy this random real estate and get lucky on just betting on
See, but that-
equity going up, that's kind of like a dirt
Yeah, but
savings.
that's all the reason not to do it. Like the only
What do you mean not to do? That's what the economy has been proving that I'm right. The past 20 years, I
didn't
see
say
real
don't buy
estate
a
go
house.
up
I didn't
without
say-
doing nothing.
I didn't say don't buy a house. I just said
But if you're telling me the guy only could get a loan only if he does 50 year
no,
loan.
he didn't say that. You said if I'm against
If
it.
he only could qualify for 50
yeah,
year
then yeah, do it because then you lock it in your price.
Okay.
Yeah, we agree on that.
Okay. So it's better do it than not do it.
But you're gonna see, like I see a lot of stuff online about better to rent than own, this and that. And it's like and now they're gonna see these people that say, oh, get a 50-year mortgage, take the money, I make 20. Like, okay, the people that own a house, they have so much. Their net worth is so much more than don't own a house.
Okay. So you're proving me right. Their net worth is more if you own a house than you do not.
Yeah.
So if you have a 50-year
So
mortgage.
if that's your only option, I would
If you have a 50-year mortgage, whatever, 20 years pass, you got 30 years more to pay it.
yeah,
Either way, your net worth is going to be worth more than you did not have it.
yeah, because you're locking in your price.
And you're locking in. And then you never know in 20 years what's going to happen with inflation. I mean, think about
Why
now.
do people don't buy? How come people don't buy? You think? Josh, what do you think? How do people just don't? They like.
Oh, they don't.
They're like 40 years old. They talk about buying. They're like they go through the late
Yeah.
20s, 30s.
Different reasons.
It's I have some, pre-approvals from 15 years ago that every few years they come back. But, I think it's either
Some of my
one.
times.
Yeah, right. It's the idea, number one, right? Like, oh, could be more expensive. And in some cases, it might be more expensive to own based on certain areas. But in general, you can find something to probably own what you pay rent for. But it's, I think some people just don't want to take care of a house. I don't think they care. Or they don't know. They just don't know.
They just don't know.
Or they're trying to play. I think a lot of people try to play the market. They feel like, it's gonna go down.
Wait for it to come down.
It's gonna go down. Like I got a guy now. I'm gonna go after
But
this.
that's like, sir, that's
So you can't play the market real estate. Some people don't. They try to play like, oh, I'm looking for this area. I want to
Yeah.
like hit it big. It's like no, you just buy something that you could hang on to.
I think it's a percentage of people. Like I think that's part of it. Some of them are those people, like the new hip guy that knows everything, that watches YouTube, watches every pro show, and then never pulls the trigger,
Yeah.
right? And he's waiting, and then never buys. Then you got the one that is uneducated. Parents never bought a house. They just don't know better.
Yeah, there's
and they
rentals
just
to
think like all they could do is rent. That's all they think. They think like I think that. Then there's ones that are afraid of doing maintenance.
Yeah.
Of working on the house. They feel, you know what I mean? So I think it's a mix, but the thing is that I feel like, what we have right now, what's the stat? We have 60% or 40% are renters in the United States.
It's like 68 or something, or 65 are homeowners.
Okay, but the homeowner increase, let's go back to 30-year mortgage, talking about the 50-year mortgage, the homeowner increase once they actually established a 30-year mortgage. Is that correct?
Correct. And they reduced the down payment from 20% to
Then you had more homeowners.
you had Fannie Mae and Freddie Mac created.
Okay,
Which
so-
allowed for low down payments.
Okay.
There's still plenty of people who think.
So 30 years ago, you got this 30-year mortgage. It created more homeowners.
Yep.
Right? And it created more wealth. More net. Then again, going back to you.
Yeah.
If you own, you're worth more than the person not owning. So I guess 30-year mortgage worked out.
Yeah, that's it.
So I think the 50-year mortgage is going to work out too.
It'll work out.
Yeah.
That's my logic.
As long as you
Call me crazy, but that's my logic. Unless there's something crazy happening in the United States and they don't bet on real estate anymore. It becomes like Italy, stale.
Yeah.
I have a house about 10 years ago. It's worth the same exact amount.
Yeah.
Because they don't bet on real estate, do not care.
Yeah, they don't care.
But United States right now is
Well,
betting
because
on real
it's all the financing. If you don't make it accessible,
Yeah,
then no one could participate.
exactly.
I would do it if you if you're good with money. If you're not and you're just trying, or you need to get in the game, you could do it. But
for the right person, it's going to make
for the
sense.
right person, it's gonna make sense. But if you're like maxing yourself out and you're the 57% guy, maybe
On a 50-year mortgage.
on a 50-year mortgage,
I think it's still okay.
I don't think so.
I think it's still okay. Because they're pumping money in the economy left and right. And so inflation keeps happening. They're covering up crashes that we should have crashes. And real estate is a hedge against inflation, keeps going up. is keeping up. Money in the bank.
I mean, it could.
If the guy is maxed out and he has like 10 grand in the bank, his 10 grand after the inflation, all that stuff is going to be worth 5,000 purchase power. And then the house is going to keep up.
If the guy can keep it for that long, some people if they're maxed out and they lose a job, if they're on the edge, you lose a job.
I'm going to go back to Josh for a second. We have a lot of clients. Net worth probably was 0, and they purchased 10 years ago.
Oh yeah.
What's the net worth now?
I mean, you're talking hundreds of thousands.
Did they do anything special?
No, you just.
Did they do anything special with the house? And did they do anything special with their, like business plan, invented a new product? Did they do anything special?
No, I mean
They probably work even less, actually.
There were plenty of people who, right after the crash, 2010, 11, I felt like we were convincing them to buy. This house is 160 grand now, and now it's worth 400.
And I'm going to take that back again, circle back again, because people that might hear this podcast say, "Oh, but that's after a crash, everything was lower." No. Even people that before purchased in 05, 06, right now prices are even actually the same or even more.
For 100%.
So again, going back from the 90s all the way here. Buying real estate, if you could hold, it's worth it.
Yeah, if you could hold, it's worth it. It's an asset. It's an appreciating asset.
Yeah, I don't know. I'm a fan of it. So
yeah, no, appreciating asset. Anytime you could buy an appreciating asset, it's good.
Yeah,
you just gotta hold. You gotta be able to hold on to it for more than 6 months.
Well, let's pick Josh Brain again. Talk about portable mortgage.
All right.
Melissa wants to know all about it.
Sure.
Because she wants.
Define what a portable mortgage is, because it's a new term.
So I'm gonna kind of break it down to, we have something similar in the government loan world. It's called a assumable mortgage. So where if I'm a homeowner and I had a 3% interest rate, someone can assume my mortgage as a new home buyer buying it, as long as they had the difference. Now, a portable one would be if I'm the homeowner, I want to take my mortgage to my new property. I don't want to lose my 3% rate. Now, it's just talk right now. But if they're able to figure that out, some of the hurdles you're going to have is, if my new house I'm buying is $500,000 and my really low interest rate is $200,000, do I need to come in with the difference? Is there a lender that's going to lend me the difference? Does that lender, now all of these lenders that were expecting to get paid in full, they're now holding this paper forever. They're holding this low interest rate loans forever. So there's a whole complex thing about it. On the surface, it sounds great.
Yeah.
I just don't know, are they going to have it mimic an assumable mortgage where people are going to need the difference?
Yeah.
And if they don't have the difference, then they just got to get a regular loan.
We don't know.
And I think lenders are probably they're not gonna like it because you're like losing money on that. Like if you have a 3% mortgage now, you're like want to get rid of it.
It's like going to cause fees and rates to go up.
Yeah.
Because if I'm doing new loans for people, and I know I still am only getting 3%, but inflation is 5%, I'm losing money here.
Yeah.
I got to jack up my fees and costs here, just like insurance, right?
Insurance,
Insurance has gone up because
There's
they
another
lost on the East and West Coast,
Yep.
but the Midwest, they're making money.
Yep, I get it. Okay. There's one other question I have for you, because today, we're fourth quarter, market update, we're talking about, and different things have been happening in the news. What is going on with that? They dropped the credit score for Fannie Mae. Like, what is that? Can you explain? Because people, a lot of people probably half of the agents don't even know.
Okay.
What they're talking about. Tell us.
So when anyone gets a loan, your lender, whether it's a bank or whether it's a mortgage lender, has to run your situation through this automated underwriting system.
Okay.
And it's called Desktop Underwriter or Loan Prospector. And so what happens is this system was auto cutting off at a 620 credit score. So if you were at 619 or below, even if your down payment was huge, you were auto declined. Now they pulled that minimum credit score out. So if someone's like a 750 credit score and then someone's like a 500 credit score, it might give you an average credit score and a and approve you. Now the rate's going to be higher and the costs are going to be higher. But the idea is that it could allow for some financing for, and there's plenty of people out there who have low credit scores, but a decent down payment. Or maybe their credit score is low because collections,
Okay.
but they pay their bills.
So when you say 750 and five, like what are you talking about? Like two people with two different?
let's
So
say
it's like
there's
husband
two
and wife. Let's say the
and
husband's
you
got.
need each other's income. And you need each
Yeah,
other's income.
so it's like, okay, we need their income, but my credit's bad, but my wife's got good credit.
And then you run it through.
Oh, so that's huge.
Yeah, it's going to help the right people. And if it puts more people into a home, or it allows them to refinance or to purchase a home rather than, sorry, I can't help you, that's good. Because there are a lot of credit scores that people had just a bad period in their life and then they're on the mend. I don't think it's going to work for people every other month paying bills late.
Yeah.
But if you had like a bad period in your life,
Okay.
and you just have low credit, it's probably gonna
Or you just don't have credit. Like you just open a credit card a
Yeah.
year ago and you paid everything cash.
So that's something else they're trying besides
Yes.
the other
That's
talks,
big, though.
right? Something else they're trying to improve the market and improve real estate for 2026. I feel like.
Yeah.
You know. And there's one more thing I heard: medical bills.
Yep.
Tell me all about it.
So
And that's huge, and we always had a lot of problems with those.
yeah. So you're talking about the medical collections.
Medical collection, yes.
All right. So
That shows on your credit.
Congress.
Because I went to emergency room and I got,
Yes.
whatever. It cost 10 grand to put a.
So the issue was a medical collection. If you had a certain amount of collections on your credit report and they were over a certain amount, you'd have to pay them off.
Yes.
Now, a medical collection, it's still, as of now, it's still reporting, but as soon as it is paid off by law, it has to be deleted. And I believe we're getting to a point where it's not even going to be allowed to be reported anymore because our cost of our healthcare is so expensive. And it's like,
Right.
if your copay is $800 to go into someplace and now you have this collection that's going to hurt your credit score, and now you can't buy a home all because you wanted healthcare.
Yeah.
That's not right.
That's not right.
So
Good.
I'm glad that is changing.
Good.
If you're defaulting on credit cards, that's different. But the medical collection
Medical, I feel like, right? It's
stuff, Tylenol at a hospital shouldn't be, $100.
Yeah, exactly.
Well, the thing too, it's like sometimes it's an ER biz that you're having an emergency. You're not thinking, oh,
don't
this
even
might
know.
not work. This, then also you get like a $25,000 bill. You're like, okay,
Yeah.
what the
Exactly.
heck?
Exactly.
So it's not like, oh yeah, I wanted to buy the new TV for the game, and I
Yeah.
can't. Not
Correct. And I defaulted on my.
These are all positive things. These are all positive things for real estate.
Yeah.
No, it's all good.
Volume is down, but demand is up.
No, I think demand's gonna be up because
Yeah,
I forgot I heard a stat about how many like the first time home buyers when they're like 37 years old or something, or 30. They're old. They're older.
Right.
Like the average.
For it's the new average age is 40. It's 40 now. The new buyers.
Yeah.
That's the high,
The
man.
new yeah, for a first time ever.
You
Yeah,
know,
usually used
50
to,
year mortgage, you're 90.
used to be. Yeah, but you can't think like that.
I'm just kidding.
We live longer now. Elon Musk is gonna make us, put a newer link.
Something,
You're gonna live
yeah.
like 120. So don't worry. Okay, I'm not sure. You gotta think positive, Frank.
I'm positive.
So negative, this guy, But besides that, I think all the stuff that's happening right now, I feel like it's really positive for 2026. You feel good, Melissa, about
Yeah,
the
I think-
upcoming market?
I think so. I think there's buyers out there. They're just dragging their feet
Okay.
right now.
So the
They're
demand is
waiting.
there.
Yeah, for sure.
Okay.
I mean,
okay.
I still have people that I've showed so many places to, but there's I'm waiting for this.
okay.
I'm waiting.
Yeah.
I'm saving more money.
Yeah. I feel really good about 26. Of course, unless there's something I can't see or foresee, right? Things could happen in a pandemic, wars. That is, we don't know. But I feel like with everything happening, with the things we're trying to change, and maybe who knows, maybe the rates go lower a little bit, and plus, like you said, people employment looks good, the numbers look good.
Yeah.
It's all there.
And people make more money. I feel like the 26 should be a pretty good year.
There has to be more inventory
Yes.
coming out. I mean, you have the baby boomers, right? Their big thing is they're going to sell their biggest asset.
Yes.
and they're going to move into the senior communities now.
Yeah.
So those homes, the younger generation, their kids aren't going to want those homes.
Correct.
They're going to, so it'll be nice because baby boomers control 38% of all real estate. So
That's a lot.
that inventory is going to make its
Yes.
way
Yes.
to the market. It has to.
100%.
It has to.
I heard nationwide there is a lot new loan applications.
Yes.
And if if there's loan application right now with a higher rate, imagine if the rate goes slightly lower.
Yeah.
Or like a 40-year or 50-year mortgage comes in place too. I mean, these are all stuff like set up to be a great year.
It's as long as the inventory comes, because if the rates all of a sudden drop, and now we have lower payments
Okay.
with the 50 year,
Okay.
right? You guys are going to have multiple offer. It'll be great.
Yeah, it's too much.
Listing,
It's too much.
Okay.
Yeah, it's
but no
listing.
one's going to want to represent buyers because there's
Okay.
going to be
So you think-
10 buyers for every one listing
Okay.
instead of 2 buyers for
Okay.
every one
So
listing.
you feel like a healthy market would be good if there's a good inventory
Get
as well.
that inventory.
Get that inventory.
Do you think the rates though? Because I think that's what's slowing it down. Because builders, from what I understand, the builders with the higher rate, they can't make any money on the with the way the pricing is, with the rates being high, they can't build.
It's the
So it's kind of like affecting that. So they can't get the new, more stuff out there if there's not building them.
think about like if you were building a house, you would have to forecast the cost of goods and the cost of labor, but you have to lock into a price now with your client, which is why they try to sell you, right? Sell
Yeah.
the clients all those upgrades,
Yeah.
building their margin. And so if they could figure out how to get the cost of wages in line to where all of a sudden it's not growing at the pace that it is growing, I think you're going to see builders building more. We get that housing inventory because regardless, we still grow 2 million people a year through normal immigration plus births minus deaths.
Wow.
We still net 2 million people.
Yeah.
Over the past few years, we netted a lot more people, but in a normal year, it's 2 million. And if our housing supply is only growing 400,000,
Yeah.
which is why
Yeah.
for the past 20 years, real
Yeah.
estate has only gone
Yeah,
up.
going up. Yep, that's true too.
We got a lot of heads and not enough roofs. You know?
Yeah.
So,
Exactly. So I know that was the opposite of the crash. The crash, they were overbuilding, and then they stopped building, and then now they can't catch up.
and they can't. No.
They can't catch up. Even with all that, that's why you should buy if you can. If you don't have anything to sell, if you could buy in the winter, right? How are your list? I mean,
Yeah,
like
no,
if you're a seller right
absolutely.
now, I'm telling my sellers, you just got to be patient and wait until the new year.
Yeah, absolutely. I mean, I've been telling all my sellers and kind of, most of them are okay. Like, hey, Greg, let's give it a try. We'll see what happens before Christmas.
Yeah.
If not, we'll just hold off, right? And come back with a bang in second week of January if the weather's good in Chicago. And I think it does, they'll be fine.
Oh,
You know,
100%.
Because then there'll be more demand, like Josh was saying before. There'll be new people that wanna buy for a New Year resolution. They get some tax money. They were in the holidays with their gatherings in the holidays, and they talk to their uncle like, hey, you should buy real estate. And all of a sudden they want to buy. So there's gonna be all these new people. Plus, I think I repeated last year too. January and February, a lot of the stats from Zillow, Redfin, everything. I think it's the most traffic of any.
Oh, 100%.
The most traffic. So that means there's a lot of buyers clicking on those websites looking for homes.
Well, they're itching. So like
They're itching.
Like Melissa said, dragging their feet. I think those buyers, they're not really. I don't want to say dragging their feet. I think they're just not motivated because they know like I don't really need a house until April, May.
Right.
But once that New Year hits, then it's like guns blazing, and then it's a snowball because then they'll be like, right now they're going like, oh, that house is still for sale. That once that turns, it's like,
Yeah.
oh, that's gone. Oh, that one's gone. Oh, can I see these three? I'm like, oh, 2 are gone. This one's
Yeah.
getting off. Then they're like, oh shoot, I gotta get
Then
some.
they-
I should have done
they-
it back
yeah.
then.
Yeah,
I
but
know.
that's why we try to like listen. This stuff ain't gonna be sitting around when it
Right,
comes
right.
January, February. It's gonna go. So
Yeah.
no, it's always thing. That's why when you get stuff in August, September, it's like it's a long
Yeah.
road to get to January. But
But it still could get done. I mean, I got a bunch of contracts.
no, I just got one done. We had inspection.
Don't get me
yesterday.
wrong.
Feeling
It
good.
takes like maybe something I sell something. I sell something in March and boom, one contract it gets done. Now maybe it took me
slower.
two times, right?
Yeah.
Cancellation,
Buyers too.
showings, buyers cold feet, but it's still
No, it
gets
gets
done.
Get there, right.
And some you got to be patient maybe if you want your dollar amount,
Yeah.
right? If you're okay to take a little loss, like last year, I sold a house at the end of the year, and I probably could have made more money if I waited for spring. My personal opinion, this is something that happened to me, my own house. But I needed to cash out. I didn't want to wait.
Yeah.
And thank God I did, because then I found another opportunity and I jumped on it.
Yeah.
You know, so, but that was me. Like, I was okay to take a loss of 20 grand. Some people, maybe they can't and they wait.
But you never
right?
you never know.
You never know.
You never know if you're gonna get
know.
the 20 grand. Like I had one.
You never know.
The one that got done.
never know.
They're like, oh, will you get more? I go, maybe. But right now,
Yeah.
they were looking at like the top. I'm like,
Yeah.
maybe you don't.
Yeah. But everybody has a different stage in their
Yeah.
life, right? Maybe a seller doesn't need to sell at all.
Oh, yeah.
Keep it for the next 5 years,
Oh, yeah,
right?
100%.
So it's depends. You know, there's not a one script. In real estate, there's not one script fit all.
Yeah.
On any scenarios, buyers, sellers, lenders, realtors, right?
People are puzzles, man. People are complicated. We all are.
Yeah, and you gotta take it step by step. But I feel overall 2026 is going to be.
Yeah.
It's going
the
to be.
real
good.
estate's not going down in 26.
It's not going down. Actually, talking about that, the guy, what's the name? The NAR main.
Oh, I know what you're talking about. The economist guy?
Yes.
Um,
Josh, you remember his name? Can we
I
look-
remember.
can we
I saw
look it
him
up?
like 3 times.
He's like he actually predicts 14% increase of a transaction for 2026.
Oh, that's exciting.
That's a lot.
I'm excited.
He predicts that.
Lawrence Yoon.
Lawrence
Yep,
Yun, yeah.
Lawrence Yun.
He's cool.
14% increase for 2026. Lawrence Yoon. And that's all he does all day long.
Yeah,
just
well, he
There's
was-
not
analyzes
going to be
market.
enough inventory if he's predicting that.
Well,
No,
maybe
but
it's- if it's more sales,
If he
he's
predicted
not
more
price. He didn't say
transactions.
price.
He's
It's-
saying more
Tra-
sales.
Yeah.
Say more
Okay,
sales.
then
You
I'm
feel-
okay with that.
He's-
'cause
he's-
that
he's
he
now
believes
saying-
Yeah,
inventory. No, because he believes inventory.
He's inventory.
We can't have rates drop and then prices go up, 30 grand,
Well,
and then the clients have the
I
same
mean,
thing.
I don't have any insight, but it's like all these people that bought these second homes in Florida, New York, here, this, that, like maybe they're just like, hey, let's just move down. Like they're done in 5-6 years.
Why would people be selling in New York?
Okay.
Oh,
Sorry, guys.
We're gonna go
New York.
We're gonna take a turn.
New York would be fine. It's not like whoever, won there, good and bad.
Well, they're not.
They're gonna last.
Just
he's
like
not
no
gonna
one
last forever.
promises anything here, they're gonna give that. Then the city council people in charge they
Yeah.
actually do it. They're like, no,
Checks
we're
and
not doing
balances.
it. No, we're not doing it. So it's all like just to get in, and then nothing gets done.
We'll see
Checks
what
and
happens.
Politics as usual.
Yeah, but overall, for areas, anything could change anytime. You got to be just stay alert and figure stuff out.
Yeah.
That's all. That's all you could do. But going back to prediction, fact checks, he predicts existing home sales nationwide are expected to rise 14% in 26. 14%. That means in transaction. New home sales are forecast to increase about 5%.
Okay.
Median home prices are projected to grow by 4%. I mean, a little bit,
Yeah.
But I think that's nation. But I think Chicago is even gonna be more than 4 if it's nationwide.
Yeah. He predicts a 30-year fixed mortgage is going to be around 6%.
Okay. Yeah. That's about
I
it.
don't know, Josh,
Yeah, I agree with
Josh was
that.
like,
Nothing says it should
Yeah.
be lower.
Yeah.
But overall, because of steady job growth, he predicts a decent 26 market.
Yeah.
So let's see what happens. I mean, so far, I feel the same.
No, me
Of course, anything could happen, right? And I feel like with these new I know I'm going crazy with this 50-year mortgage, but 50-year portable mortgage, medical collection being a race, all these little things are going to help.
Oh yeah, that's all. It all just gets people in the door, and then they give. It's an opportunity for people, right?
And also, too, I think, sorry to interrupt you. I know you were saying about inventory. I think there is going to be more inventory because now people are like, everybody was holding off from 21, 22 with their great rate they had.
Yeah.
I think at this point, they're like, hey, it's 2026.
Their
I've been holding off for
families
3
have grown
years.
too much.
It's not going, it is what it is.
Yeah.
And that's it.
Their families have grown. I mean, if you
Yeah.
need that basement, you need that extra.
If you want, you want it, you just get over it. You know what I mean?
Yeah.
And they probably got the equity. They're gonna make the move.
Correct.
But,
Yeah.
I think overall, guys, it was a great podcast. Jackson needs to go to his kid conference you had?
My first parent-teacher conference.
Wow.
Just listen, you know.
Yeah.
That's
I'm
it.
just gonna listen. Wait, are you not supposed to?
Our kids are getting married almost.
Yeah,
Your kid,
teacher.
you know.
So it's like,
I know, your kids are
I'm joking.
Yeah.
I'll give you like what they say, you know. Oh, your kid's a leader. I mean, they're bossy, or, you know.
Yeah, right. Your kid's very free spirit, meaning they don't sit still.
All those sugar code words. No, that's good. It's awesome. Anyways,
Anyways,
was a good podcast.
It was a great podcast.
See you guys. See you in the next one.
I guess see you in the next one. Frank wrapped it up. Ciao,
That's it.
ciao.
Come feel the love. It's a love.